Hi, everybody. I'm super excited to be here today. My name is Sarah Chase. Few people here know that I actually started my career here at FounderMade as an intern when I was a freshman in college at NYU in 2016. I worked there all through college, working my way up to leading investor relations, where I helped many of the brands in our ecosystem fundraise and meet strategic investors. Fast forward to today, I'm speaking as a founder and investor. Since leaving FounderMade and to today, I've actually started a fintech company called Capital, which was recently acquired. I spend a lot of time angel investing and scouting on behalf of Andreessen Horowitz, and I'm super excited to be here today talking about the future of investing with a great group of speakers. Julia, do you want to? Amazing. So I figured you guys could all do a quick intro on yourselves. If James, you want to go first?
Sure. Can you guys hear me? Yeah, okay. Hi, I'm James Hicks. I run the studio at Science Inc. We're a technology incubator and venture capital fund. I'm also the founder of a company that we launched within Science called Final Boss Sour that's has a booth here today.
I'm Jessie Draper. I run Halogen Ventures. We invest in early stage female-founded consumer technologies. Right now we're really focused on future of family as a category. So that's how do you support families at work, at home, the health of the family, and the financial health of the family.
Great. Hello, I'm Brian Lee, and I am the co-founder of LegalZoom.com, ShoeDazzle, and The Honest Company. And I've just started my fourth company called Arena Club.
I can't believe I'm on a panel with him. He's amazing.
And I also run a venture fund called BAM Ventures. We invest in early stage consumer brands and consumer tech.
Amazing. So I thought we could spend some time understanding how you all evaluate an investment. So if you're looking at product, market, team, and timing, how are you ranking those in order of importance to winning as a brand today?
Start with me?
Yeah.
So I think it depends on the sector. If it's CPG, which I'm kind of talking mostly about today, I'd say product is probably first because the best team in the world can't make a product taste better than it is. So product first and team second, shortly after that. And I think if you've got a really strong product that drives repeat consumption, and you've got a strong team that can kind of weather the storm, I think you're okay with timing and market. I think you can kind of figure out what to do from there.
Yeah, makes sense. Yeah, you guys can go.
While the product is really important, I look at it as, this is a 10-year marathon, 14-year marathon sometimes with these incredible founders. And I think the team is absolutely everything. I spent a lot of time getting to know the team. And I think I put founder first, and then we're excited about the product also and want to make sure, I think it's a combo. You have like product, team, and traction, but I really look at the team first.
Yeah, I'm on the same page as Jesse here, and to James. It's for us. It's really all about the team, the founding team. We have a very simple saying at BAM Ventures: we have to love the team, not hate the idea. And so that's how we approach things. Timing is also important. I've seen many great ideas and great teams, fall by the wayside because of timing. So I would put team, timing, market, and then product last.
Yeah, that makes sense. I feel like we see a lot of times when a good team and a good product will create a market. So it makes sense that that's lower on the totem pole for you guys. Next, I wanted to kind of cover how your investment criteria and approach has changed in the current economic environment. How have you changed the way you value growth versus profitability? Brian, if you want to go first this time.
Sure. We all know that timing has really changed in terms of the venture world. Valuations have definitely reset since a couple years ago and even last year, and even 5 weeks ago. It feels like valuations have really kind of settled down. But we have a very long-term horizon when we invest because we're so early. So we invest in kind of pre-revenue companies typically. And so for us, we've always looked with an eye towards how do you get to profitability. But we're still early enough where we actually pay attention to growth. Like not growth at all cost, but it has to grow because it has to be exciting for us to participate in a company as opposed to just pure profits. There has to be a combination of both, but with an eye towards a good path to profitability would be great.
Comments?
Yeah, profit right now, the majority of our companies, about 2 years ago, we were like, maybe more than 2 years ago, we were like, hey, okay, we're not growing. We're going to get profitable for most of our companies. There's still a few, and to Brian's point, like you need growth in this market. You need some sort of growth. But some of our companies, I'm like, look, don't feel like a failure. 30 to 60% growth year over year is okay. It's not a typical like 2x, 3x these days for every single business. I would get as profitable as you can, as early as you can, but you still have to do, some of our companies are brand plays, and we're evaluating everything from, sponsoring sports teams, which I shut down very quickly, to many other brand partnerships. And so I think, you need to find the most bang for your buck. The issue today in consumer right now, I think, is also Google ads. I think it's really important to talk about Google and Meta right now. They're too expensive for everyone. I don't know where the ceiling is, and if anyone's at Google, I'd love to talk to them today. But they're putting companies out of business. They're sinking small businesses because they can't afford digital acquisition. And so people are looking for much more creative ways, and they're not using, the traditional ways of getting, you just can't be profitable if you have to digitally acquire your customers via Google and Meta these days.
Yeah, I totally agree. And I'm all in for the, protest against Google and Facebook on their ad prices. I think I totally agree with everything. Everything we do is really early stage, so like true profitability is kind of a pipe dream at that point. But what you want to see is you want to build the little blocks that can lead to profitability, right? Which is things like retention, things like organic, virality, little kernels of things where you could project it and say, okay, if we, invest a little more in this and this kind of continues and this continues to snowball and flywheel, we'll achieve profitability a lot sooner now than we had ever kind of predicted probably 2 or 3 years ago.
Yeah, that makes sense. It seems like there's an emphasis instead on capital efficiency more so than ever before. James, this is specific to you in science. I'm curious, how do you guys go about validating an idea, and when is the right time to bring in outside capital?
Yeah, we do a lot of testing. The best ideas start with just a lot of founder conviction, which you don't really test, but if it's something that we're, a sector we're thinking about going into, or, a product we're thinking about launching, because of technology now, we can pretty easily throw up a landing page and get some feedback, buy some expensive meta ads against it and see, how people are converting, how people are reacting. And we can get a good feel for, is this something that people will respond to? But yeah, you can do that for really cheap nowadays.
Yeah, makes sense. Okay, switching gears now, I want to talk about D2C versus retail. We often hear that brands need a retail footprint before thinking about acquisition, and I'm curious if you guys think this is fair to say. Does staying strictly D2C always hurt exit multiples? And are there instances of having an owned, unique community? Is that ever valuable in itself, knowing that an incumbent or whoever can come and expand you into retail?
Let me start?
Yeah, sure.
I think D2C is still really valuable. The knock on it is what Jesse alluded to earlier, where it's like if you're literally buying every customer for this exorbitant price, it's impossible to scale profitably. So retail in that case helps. I'd say when we did Dollar Shave Club, a large chunk of the value, even into the exit, was the fact that, unlike all the other kind of shaving products, we knew all of our customers' names and we could text message them and email them, and that's still, I think, really valuable. So I think it's a mix. I think when it comes to retail, I think what you want to show is just like a lot of kind of concentration and prowess and stickiness amongst like a few kind of key strategic retailers, and some ability to also kind of understand that customer and know that customer and get a portion of that customer's information as well.
You guys, any comments? Yeah, Brian?
So I think it's all incredibly important, right, to build a brand. Just a story for The Honest Company. When we started The Honest Company, we were 100% direct to consumer for a while, for probably the first 3 to 3.5 years. And it was in my head that we would always be an e-commerce D2C player. But then what we realized was that, at that time, only 12 to 15% of commerce was coming from online. And we realized that if we really wanted to achieve our mission of creating a non-toxic world, we had to be where the shoppers shop, right? And that was really the decision to move into offline retail and move into Target, Costco, and Whole Foods and everywhere else. And that's really the impetus of it. But I realized something very quickly was that our offline channel was more profitable than our online channel, right? Because for a lot of the reasons that you talked about, Jesse, in terms of the cost of marketing and advertising and Google and Facebook ads and so forth, as well as shipping a 50-pound box of diapers across the country wasn't cheap. And so there was a lot of reasons why e-commerce wasn't as profitable for us as the offline retail was. But in today's world, I would say they're equally important. But I would probably, if I was limited on resources, of course you want to start with a Shopify site or something like that, keep costs really low, go direct to consumer, start building your brand that way, and get as much organic and viral traction as you can, and then make the decision from there whether or not it makes sense to jump into offline retail.
Yeah, I'd agree. I agree with Brian. I mean, when I look at my brands, like we came out of the D2C boom, 7 or 8 years ago, and now all of them are really leaning into retail, especially during and post COVID. But we believe in really an omni-channel strategy. You need all of it. You really do. And acquirers look at you as much more de-risked if you've jumped through the hoops to launch in retail. So that's a really important piece of the pie before you sell.
Yeah, that makes sense. I feel like incumbents, their strength is oftentimes retail, so they want to know that their engine is going to be powerful for your product. So it makes sense to get some validation there. I'm curious, what white space in consumer are you all excited about right now? Jesse, if you want to kick it off.
White space in consumer. I mean, there's incredible new products every day. I think everyone should be thinking about, how we recycle, everything to do with the climate. We did a whole deep dive on baby stuff, and apparently they throw away 1 million strollers and baby car seats a year, which is ridiculous. So how are we going to solve that problem? But really, we're very, very focused on inefficiencies in childcare and affordable childcare. And that's something that we're really excited about. It's been underfunded, and it's a big market opportunity.
Yeah, makes sense. Just going off of that, do you think that has anything to do or correlation with female founder ratio, like female to male founders, and there just being less female founders that have felt the problem?
We have male founders and female founders in that space, and I think we need everybody. We are not a man-hating club. The questions I get often are like, what if a guy works there? And I'm like, okay, well, hopefully we're building billion-dollar businesses, and eventually thousands of men will also work there. But we need men and women tackling these problems for sure. I see founders. I actually see, an equal amount of founders, I think, in this space. Women and moms in particular are really focused on this problem, building incredible companies. There's one local to LA called Upwards, formerly We Care. They have 66,000 in-home vetted childcare locations. It's the most affordable childcare option on the market currently, and they fill these spots there. The technology kind of overlay. Everyone should know about this business because they're just game changing right now. But there's so many different ways to tackle this. We have an adoption technology that sells into social services. There's a lot of interesting things we're excited about in that space.
That's amazing. Do you want to go next?
On the white space?
Yeah.
Yeah. Echoing off the adoption, place. So what we've seen over the last 10 years has been a lot of investment and a lot of companies that have been built for high earning millennials. And there's been just huge demographics that have been kind of under created and under invested in. So there's a ton of white space there, particularly in services. We've got a few investments and incubations in kind of gov tech to help certain populations of the U.S. and there's just a lot of kind of missing sectors out there still.
Yeah, it makes sense.
Yeah, I think there's just white space really everywhere. Every time you think you've seen it all, you see more. I came here early and I walked through these aisles. I was like, wow, there's a lot of innovation happening across the board. And it's exciting. It's exciting to be in our space investing in these future brands. But in terms of white space, I think there's a tremendous amount of white space in consumer tech, I think, and especially when it comes to logistics, right? So return logistics and getting product to the customer faster, cheaper, and so forth. I also think there's an incredible white space in the better for you product market that's affordable. Because I look around and I keep seeing more and more sustainable, better for you products, but at premiums. And it's gotten to the point where you could drive a lot of these costs down, because as we head into a recessionary period, people don't want to pay up all the time, right? They're looking to save money. So if you could create better for you products for the masses, I think you're going to win.
Yep. Awesome. So I thought we could open it up to a little Q&A. If you want to raise your hand, and then we can...
We had a big debate if we should have Q&A, and
we got some time. So.
We have time.
Yep.
Well, I want to say it's a phenomenal event, and thank you for participating. And I have a particular question for Jesse, but for the panel. What is your opinion of Web3, and why is it an anomaly in the U.S. when it's so popular in Hong Kong, Asia, particularly Singapore?
Oh, it's for me? We don't do as much investing in Web3, but I am a crypto, investor, and and everything we're looking at in fintech, even in estate planning online business right now, we're thinking about, okay, well, how do we estate plan for digital assets and plug them into Coinbase? And, I think it is the future. Especially this impending recession, which I feel like it's debatable. I think we're in it, but, we are always sort of it's like this impending thing coming. You should be thinking about putting your money in crypto and in these other places to diversify. The government's significantly in debt. I don't want to get too conspiracy theory on you, but that's how I think about it. We don't invest in Asia and Singapore yet, but they are very ahead in a lot of this. China's sort of not accepted all of crypto, but anyway, that's where I stand. Very focused on childcare right now, though.
Web3 is just a blockchain. Should we look at Web3 as just a blockchain, or is it not a next-gen, Gen Z
No, it's
solution?
a next-gen thing. I think there's really interesting things happening on Discord, and, we're making sure all of our companies are taking that into account also, Web3 completely, but I look at it like that's where it kind of began, and now we're in this new Web3 opportunity. We're seeing some great companies touching Web3 right now too.
Hi everyone, I'm Haley. This is an incredible panel. My question's for Jesse. So I do have a clothing brand. It's focused around the military women's space. And when you're looking to invest in companies like that focus on women, are you looking for an international market or more focused on the U.S.?
International markets are much bigger, so I love international markets. We invest currently domestically to the U.S. and Canada just because of the size of our fund, but we're looking for companies that will scale internationally. I just can't believe that Brian Lee is sitting next to me, and I can't believe you're asking me questions. He started on his company in LegalZoom, and I'm just fangirling. He's the best. James is great too, but I just met him.
Question for you guys, Ashley Farron here. Can you talk a little bit about how you see the future of the creator economy as it impacts both D2C brands and retail? Any trends that you're looking at there, or kind of evolutions in the world of commerce when we look at the impact that influencers and other digital creators have on that ability to build brands and sell products?
So it's a great question. The creator economy is here to stay. It's only going to grow. I see a world where all of us are creators, right? Where we all have a footprint and followers, and everything you do or post on social is meaningful and could drive revenue to whatever you're doing. And so, look, it started in 25 years ago when celebrities were starting companies online and so forth, and the power of influence that led to all that, and then came the reality stars, and then came the online influencers, and now all these other creators and so forth. I think we're just touching it now. I really believe that. I think you see some of these massive influencers, right? The online influencers like Mr. Beast or Jimmy or Collins Key, all these influencers that are out there, and they build businesses from $0 to $1 billion, right? Like almost overnight, it feels. But so I think it's just starting. There's so many opportunities out there to even go partner with influencers and to promote your brand and so forth. And it's getting more and more affordable, truthfully, because there's just more and more creators and influencers.
Yeah, I agree with that. I mean, when we incubate or create companies, we're basically now training them all to be creators, whether it's from the founder themselves kind of posting their daily journey, or, taking a creator and pairing him with, or taking a founder and pairing him with, a leading creator. It has to be part of your story. It's how you, communicate brand. It's how you educate consumers. I totally agree with Brian. It's here to stay.
Yeah, just a little addition. When I raised for my last company, we had a partner meeting with our partner at Andreessen Horowitz, and he told me and my co-founder that we both need to start posting on social platforms, and so we decided to go on TikTok. But even in fintech, it's relevant, so I think it's definitely here to stay in consumer as well.
Thank you, guys. Yeah, I just have a question about how brands are balancing personalization with the lack of data and the further lack of data coming down the pipe. So third-party cookie deprecation on July 1st, 2024, different data privacy regulation. How do brands, you see, kind of balance lack of data and the personalization required?
Yeah, I can take that. I think I got it. So, post iOS 14.5 has been, super impactful, right? And mostly a negative way to our brands. The positive aspects, I'd say that it's forced our brands more to create these like owned and operated channels, whether it's, a community on Discord or, a SMS community. It's forced our brands to really try harder in a good way, and I think it's separated a lot of the the good from the bad in that respect. And it's also kind of accelerated the push to more omni-channel, more focused on taking back to our roots of like traditional brand marketing and creating desire versus like more direct response, kind of one-to-one acquisition and optimization. So it's definitely had an impact, but I actually think it's creating better companies.
Hello. Oh, sorry. Hi, I'm Christina. I started a company called Coobs. It's an underboob sweat pad, which never existed before I invented it. And I've been lucky enough to self-fund my company so far. But my constant question to myself is like, when do I take outside investment to really try and accelerate growth? And I was just wondering if any of you have any insight as to if there's any, not necessarily a formula, but advice you can give in that regard.
Okay. I look at it like when you're ripping at the seams, when you really need to hire more in order to take advantage of some big deal you just got, or, I think that's a great time to raise. That said, you need to make sure that you're building $1 billion business. So you need to be able to prove that to whatever investors you're meeting with, because our model doesn't work unless you can return $1 billion and return our fund hopefully many times over, as Brian did with Honey, which you guys should read about if you aren't familiar. It was a good deal. But you need to be able to build that out. You need to be able to build out that market. So if you have this one incredible flagship product, what's the product roadmap look like, in the future? So that's what I'd say, is just be ready with that. Oh, thank you.
I kind of feel the same way. It's actually, I would say don't take capital unless you have to, right? You're much better off owning the company on your own if you could build it off of and bootstrap and get it there, right? So that's what we did with LegalZoom, right? We were actually lucky that we couldn't raise capital, right? And that's really why the company survived, because we had to get scrappy and smart and actually grow with our own profits. And there's a lot to be said about that. Hey, Leo, how are you, man? Sorry. So I would say don't take capital unless you have to, or unless there's a real clear path, what Jesse mentioned, to $1 billion in revenue. Like, okay, this capital is going to really accelerate and help us get there, and I still have a clear path to profitability by taking this capital, because honestly, you're going to have outside investors that are going to be chirping in your ear. We just can't help it. Seriously, it's like we're going to tell you everything, and you're not your own boss anymore, right? It's like you're now a team. So just be prepared for that if you do take outside capital.
Awesome. Okay, I think we have to wrap it up because we're at time. Thank you all for an amazing conversation. I hope everybody walks away more educated and confident in their approach, whether you're investing or building yourself. And I'm sure we'll all be around for a little bit. If you want to try to find them and ask questions, but otherwise, enjoy the show.
Thank you.
Thanks, Sarah.
Thank you, Sarah.